Good afternoon. How are we all? And this really hot and uncomfortable day, but obviously we've tried to get the temperature down in here, at least to get started. But sorry, it's not ideal ever in these relatively small rooms. But anyway, I'm delighted that so many of you have come this afternoon to attend this panel session. And we're going to try and give a good go to the title of Do Delegated Authorities Matter and Deliver Value to the Insurance Market? You might say that actually it would be a bit of a crashing shame if the conclusion was no, they don't. But anyway, it remains to be seen how various people will feel about this. So what we're going to, we've got about an hour, and please, obviously one of the major objectives of this is for you to obviously be able to ask our distinguished panel any questions that you would like to do. But we're, in the sort of introductory remarks, we're going to try and cover a sort of fairly wide spectrum of the topic. So we're going to try and look at views on pros and cons of delegation of authority, and most importantly, obviously, we're trying to stress that there's delegation of authority in the market very strongly on the claims side as well as on the risk underwriting side. So, you know, that is obviously a key theme for today as well. We're going to try and look at things from the perspective of, you know, the regulators, the policyholders, the capacity providers. You know, what is done well, what could be done better, what's going on with innovation, do delegated authorities add or detract from service, and, you know, basically how can the capacity providers and the overseers of the market obviously get the best from yourselves, obviously, as representatives of the delegated authority market. So that's the subject matter. Just briefly to introduce myself and our very distinguished panel, and thank you, ladies and gentlemen, for making the time, because everybody's very busy. We had a slight moment of hysteria just at the end. Charles Manchester, bless him, who is CEO of Manchester Underwriting, was supposed to be our MGA representative, so classically we could have ended up with a panel here of the great and the good from everywhere else and nobody from the MGA market, but Catherine has very kindly said that she will stand in. So I'm Sian Fisher, and I'm a founder director of the MGAA, so with Reg and the steering committee members I've been involved in this journey for about the last 10 years, and it's absolutely fantastic to have come today and see so many people here, because we had great fun the first year, but it was a bit of a speed dating event, and it's come a long way, shall we say, from those early stages. So if I could just introduce our distinguished panel here today. You will undoubtedly recognise the names. The full bios are available on the website, but we've got our two distinguished overseers of the market here in Simon and Peter. So Simon Green is from the FCA, and he has the unenviable task of looking over the general insurance market in all respects, and also market protection of that for that sector. And Peter Montanaro, I'm sure lots of you know Peter very well, but he's obviously in charge of delegated authority business for the Lloyd's market. Then we're very pleased to have Mark Thompson, who's here representing the sort of delegation, the claims management side of the business, and Mark is CEO of Cunningham Lindsey International, and at a personal level has obviously done everything from personal loss adjusting to forensic accounting, all sorts of things across the world. And sitting next to him, we've got our insurer capacity provider representative, James Weatherstone. I always say Weatherstone, don't I?
Thank you. Many do.
Shows where I spent most of my university years. And James is CEO of Arch International, and probably a number of you know that Arch were very involved at an early stage with some of the bigger MGAs in the market, most latterly sort of Dual and the development of that, but now are supporters of quite a wide range of MGA members in the market. Catherine is chairman of INET3, which has had basically right from scratch development as an independently run and owned MGA specialising in non-standard property business. So is a classic MGA business in the market. And then our distinguished specialty broker representative is Chris Hardcastle, who runs the binders and facility division of Arthur J. Gallagher, and for his sins actually worked very closely with me when OIM was bought by Gallagher's, and I think half his team are actually standing at the back of the room. And some of you probably know that OIM had a very large facility that was placed with some of the major insurers in the market, but it was actually Chris, obviously, who worked very closely with us in getting that facility into place. So that, ladies and gentlemen, is our panel. So what I was going to do, just as a sort of to get things going, was just to sort of give a very open prompt to each of the panel members individually, so they could sort of give you a picture of their positioning, and then obviously hopefully that will lend itself to you jumping up from your seats and asking them lots of questions. And actually amongst the panel, what I would just ask amongst the panel is if people could just have their say first, and then, because I know sometimes it's very tempting to jump straight in and with your own side of the coin, but it would be helpful if we could just hear the positioning remarks first. That's be kind. Thank you. So we're going to pick on Peter first, since the A is sitting in the middle and B, most of you know him. But the main reason for asking Peter to just sort of open is that Peter's actually been involved with the oversight of the delegated authority space for somewhat 10 years, maybe more. And so obviously he's seen a lot of the development of the market space in that time. So we'll let Peter give us an introductory overview of his experience of the space.
Okay, thanks, Sian. Afternoon, everyone. It's actually about 7 or 8 years. It feels like 10 or more, but
20.
No, I think, yeah, maybe. I suppose from my perspective, things have changed an awful lot over those 7, 8, 10 years. Delegated underwriting business at Lloyd's was very much the poor relation for many years, and giving the pen away, people tended to look down their nose at that. I've worked for 2 bosses at Lloyd's, Rolf Toller and Tom Bolt, both of whom had a fairly low opinion of delegated underwriting. Rolf, I think, because he has a low opinion of anybody holding a pen that isn't called Rolf Toller, and Tom, because of some previous experiences he had at his previous job. So it's always been difficult in the sense that I've always reported to someone who's always been a little bit concerned around the risks attaching to the delegation of business. And then I suppose suddenly, about 5 or 6 years ago, Lloyd's commissioned Deloitte to do a review, strategic review, and somebody did the maths and suddenly realised that a third of our business was coming through the cover holder channel, and so perhaps we should give them a little bit more respect. So we were suddenly given some electricity and some stationery and some chairs in the office, which was rather nice, and a travel budget, which was also good. And there was then more focus on trying to build that business up and cuddle up to our cover holders, so to speak. So rather than just take all that business for granted, which had been very much the case, I think, previously, was to go out and start talking to cover holders, find out why they liked us or indeed why they didn't like us. That in itself was a challenge, because when I joined Lloyd's, or certainly within the cover holders department, we weren't really allowed to talk to cover holders, which I found a bit strange, and I inquired why. And I was told that the relationship with cover holders was very much one for the broker and for the underwriter, and the last thing they want is the regulator walking in and ruining it for everybody. So, but I sort of went to the various committees, of which there are many, and explained that I was going to start meeting cover holders, and it was a bit like the gunslinger walks into a bar, everybody suddenly stops, a piano player stops, and there's all sorts of arguments. So I did agree that when I would go out to meet the cover holders, anybody that wants to come with me could. So for the first couple of cover holder meetings, there were plenty of brokers and underwriters sat with me, but they soon realised that compliance wasn't necessarily the most exciting thing in the world. And in the end, I think they've learnt to trust me. Now I meet them on my own. And then in the last 5 years, really, the business has grown at Lloyd's. We are far more proactive in terms of engaging with our cover holders. There's a whole stream of work going on at the moment about ease of doing business. So how can we possibly make it even easier to do business with Lloyd's than it already is, and listening to some of the feedback we get from the market as to what we can do to improve things. And the makeup of those cover holders has changed quite a lot as well. From traditionally, one would look at the book of business as being low value, high volume business is generally what you expect to find from a cover holder book, which is absolutely right. But today we see lots of different versions of the same thing. So brokers who suddenly pretending they know what they're doing, picked up a pen and started writing business and facilities and charging extra for the privilege of us receiving the same business as we did before. And also underwriters that were perhaps felt they weren't quite so rewarded within their syndicates, so have taken to setting up or joining their own MGAs looking to write exactly the same business and then bring that back into Lloyd's. Now, we can't, as a regulator, only a little regulator, of course, stop that. We just need to make sure that it's managed properly now. With those underwriters that are now writing business that more traditionally would have been written on the box, I suppose, we just have to make sure that they're treated the same as our underwriters that are underwriting on the box. So these, we've rolled out a whole set of new standards for those particular cover holders, because we want to make sure that they meet exactly the same requirements as our underwriters on the box. So I'll stop talking about Manchester underwriting now that Charles has arrived, and just wrap up like that, I think, to say that it has moved a lot. There are some cover holders that are one-man band, mom-and-pop operations, and we have those others that are maybe 3 or 4 times the size of some of our syndicates. We have room for all of them within Lloyd's, as long as they're making us money and looking after their customers.
So, Simon, so you've obviously very recently, and I hasten to say that the FCA didn't actually come and ask us what the theme for this panel was going to be and then do their thematic reviews, but it was very good timing in relation to. So you've obviously done your thematic reviews on both SME claims and delegated authority in the general insurance market. So I'm sure you will have some key themes that have come out of that work to share with us. Thank you.
I do, thank you. And I promise I'm not the conscience on Peter's shoulders here. We do work very closely with Lloyd's and with the MGAA, so I'm very pleased that we've been invited here as a regulator. Don't get out often, and it's a really good opportunity for us to be able to engage and converse with you, and we've got members of the team here as well that have been around all day, so hopefully you'll have had some conversations with them. So, just picking up from Peter's theme, I can say that we neither cuddle nor have a negative perception of MGAs. Fully recognise the role that they play in the market in terms of not just the premium income that flows through the MGAs, but also, as we mentioned earlier, some of the claims handling pieces as well, and the involvement and engagement there as well. One of the key themes as a regulator, as a relatively new regulator, Financial Conduct Authority, that we've been looking at across the general insurance market is not looking at it in terms of function and not looking at it in terms of firm, but actually trying to look across the market. And it's a very diverse market. And it's a market that is highly interconnected. So the themes that run through a number of our thematic reports, or more recent thematic reports, are really picking up on that interconnection. And one of the elements, maybe to disappoint Sian a little bit, is that we're not looking at this for the value that MGAs bring to insurers. We're looking at it very much for the value that this brings to consumers and the benefits it brings to consumers. Having said that, our remit on consumers is very broad, so it's not just the purchaser of the insurance policy at the end of the chain, it's actually in terms of the market and market integrity as well, because we're actually looking at the market counterparties and how they interact together, hence the focus on distribution shares. The other element that we're looking to test through a lot of our work is to ensure that actually where counterparties come together, either in terms of products or services, to provide end products to consumers, each element of that chain, that distribution, works effectively together to give consistent outcomes to consumers. So no matter what route a consumer purchases your insurance product from, actually it should be the same outcome in terms of the product service and the outcomes from the delivery of that product or service to them. So there's probably three thematic reports, just very briefly, I'd touch on that we've looked at within this area. Firstly, I think the conflicts of interest piece that focused very much on the larger intermediary market, and that was looking again, picking up on some of the things from Peter around developments in the market over the last 5 or 6 years, where actually the roles of intermediaries have changed considerably in terms of the functions and the activities that they undertake. And that brings increased complexity to their business models, but also the increased risk of conflicts of interest arising that could be detrimental to the end customer. So there are a number of elements of that piece of work that we looked at, specifically around the business model and the business structures and the remunerations and the remuneration arrangements that were in place underpinning that. And the key findings from that were that elements of conflicts do emerge across quite a number of these business models, that the lack of focus sometimes on the controls and the identification of the conflicts or potential conflicts as they emerged was creating some risks. And the key recommendations for us were very much around making sure that there are proportionate frameworks in place to be able to identify, monitor, mitigate and manage any conflicts that arise. And I'm pleased to say that one of the outcomes from the thematic report, particularly in terms of the engagement that we've had with the industry, is that we've seen some movement in terms of simplification of business models, improvements in those control oversights, and improvements in some of the management information that underpins that. That flows on a little bit onto the topic you mentioned, which is the Delegated Underwriting Authorities, which we published recently. And again, picking up very much on that theme of looking at the interconnection of the markets. So we looked at a wide spectrum of insurers, intermediaries, third-party administrators. And from that, we can definitely see the value that the Delegated Underwriting Authorities can bring to consumers. I think there's a number of areas where we saw that, specifically around the niche customer knowledge and experience that DUAs can bring, how that can result in better quality products, more focused products, and actually the evolution of product development as well as customer experience and the product purchase life cycle progresses. I think secondly, in terms of the specialisation and the focus that DUA can bring as well, particularly in terms of providing efficiency and effectiveness with a narrower focus and a smaller span of control in terms of providing speed and effectiveness of the process. I think thirdly, just around benefits in terms of innovation of distribution and innovation of distribution routes, but again bringing value to customers in terms of providing useful and valuable insurance products through distribution mechanisms that actually suit their needs and their purchasing habits as well. Having said that, I think there are also areas that we highlighted in the report where I think we found that there were issues around both the understanding of what we think are the relatively clear regulatory requirements and the requirements under our guidance on distribution and product providers. And I'll just pick up on a couple of those. So I think firstly, there was a concern around insufficient focus on the product and the performance of that product in the eyes of the customer. And that led to questions around the utility and the value of some of the products and some of the elements of value that parties within those chains were bringing in the distribution of the products. I think secondly, there was, for some of the areas that we identified, insufficient attention that had been given to the product design and ensuring that it actually met real customer needs and customer outcomes. And through that also, a lack of focus in how those products would be distributed and delivered to end consumers. And then finally, a lack of clarity in some of the areas that we're focusing on in terms of responsibility and relative responsibilities within the chain of delivery from the underwriter through to the distributor. So whilst we can understand and we can see considerable benefits from the use of delegated underwriting authorities, there are a number of clear areas that we identified where we think the industry needs to come collectively together to think about how we can manage some of those potential risks. And then finally, we talked about delegated underwriting authorities very much in the underwriting sense. There's also a delegation in terms of claims, as Sian mentioned. And we recently published a thematic report looking at claims and claims handling for SME customers. And SME customers specifically because we see a convergence of firms' business models around that market, but it's also a customer group where potentially the insurance needs and requirements are relatively complex, but the capability and understanding of some SMEs falls behind that complexity. So there's a potential mismatch in terms of the purchasing. Again, broadly speaking around the SME work and the claims work that we did, there was concerns around lack of clarity as to who was driving the claims process in the chain, around communication between the SME and the claims handlers, and around the perceived poor experience that some of the SMEs were exhibiting from that. I think, again, positive response back in terms of the work that we've engaged with in terms of the ABI, BIBA and MGA as well, in terms of looking at how they're producing additional guidance and support, and we'll also be picking up with BIS and the FSB as well in terms of providing support for SMEs in purchasing insurance. So I think 3 areas just very quickly covering distribution.
So, Charles, welcome. Very pleased to see you here. I didn't obviously introduce Charles because he wasn't here, but Charles has had a very interesting history in that he's been involved with delegated authorities both as a broker and now as CEO of his own MGA, but also in between he's actually been CEO of a mainstream insurance company in HCC International, and that had a secondary interest in that it was both an insurance company and had a Lloyd's syndicate. So as a sort of representative of the MGA space, but somebody who's seen things from lots of different angles, that was obviously why we were keen to have Charles sit on the panel. But given that you've had that sort of wide range of experience, why did you come to be an MGA CEO, and what are you seeing going on in the market today?
Well, I came to be an MGA because either side of running HCC, I'd run my own brokerage operation, and then I now run the MGA operation, and I've never been happier than when I run my own business. Except the bit in between when I was happy and not having the angst of running my own business, which most of you will understand. The thing is that I recognise a lot of the points in the FCA thematic review, and they're all very well made. But I have, on odd occasions when I've been asked to do presentations or business plans, I've got a slide where I sort of show that on one end of the chain you've got the insured, and at the other end of the chain you've got a bunch of capital providers, and they take the risk transfer ultimately, and in between you've got everything that takes value out of the chain, and they need to add value back to square the circle. And in that bit you've got insurance companies because they raise capital, it's not their own to start with. You've got MGAs, you've got brokers, you've got loss adjusters, you've got lawyers, you've got all sorts of animals that take something out of every pound of insurance premium, and they've got to add value. And sometimes there can be a lot of them in the chain, and sometimes they all add value and sometimes they don't. And so in answer to the question, do MGAs matter and do they deliver value? Well, only if they deliver value, and some do and some don't. And I think the biggest change that I've seen, well, several really, but I think next year will be the 30th anniversary of my first binder. And the biggest change is that people are actually having to justify writing binding authorities far more than they ever did do, and that's insurers. And MGAs have to justify their existence far more than they did do. And in the early days, the focus was totally on the underwriting result, and very often not even on that. And there was all sorts of sloppiness in the market, such as the sloppiness of sales. Some of us have probably been around long enough to remember the travel insurance debacle in was it the 80s or the 90s, when cover holders were effectively, well, they were sub-delegating and the cover was only being bound on the risks that had claims. And that impacted the Lloyd Central Fund, I think, back in the day. And I remember that very well. There was multi-guarantee, which I think was a binding authority as well, which I'm not sure if it impacted the central fund, but it certainly cost the market an awful lot of money. And here you've got underwriters that don't really understand the chain, and they don't really understand the product in many cases. And, you know, that still persists in some cases, and I'm not surprised at some of the contents of the FCA review. But it really shouldn't be like that, because you know, if we're not delivering value to the people that pay the premium, then we shouldn't be there. And hopefully we are, and a lot of them, as has been said, do have sort of niche expertise and things. But one of the biggest changes as well is that now you have not quite mega MGAs, but really quite large ones, such as Dual. And you also have MGAs putting down really quite large line sizes on very large risks. I think there's an MGA that specialises in energy insurance, where a line size of 10 million just wouldn't attract any attention. And so things like that have changed, and MGAs do have a lot more clout, and hence we have an MGA association. One thing that does concern me a little bit about regulation, and I really don't want to fall out with my friends to the left here, because actually I agree with pretty much everything that they will have said when I wasn't here and when I was here, is... well, maybe not. But I think the oversight of sales is something that is... I'd be interested in their perspective on this, because it's one of the things falling out of the thematic review that raised my eyebrows a little bit, because... if one's an MGA that doesn't deal with appointed representatives, that doesn't have its own agents, but deals with independent brokers that are independently authorised by the FCA and that are chosen by the insured rather than by us, it is that broker's job to determine for his client whether a product is appropriate or not. Now, we sell products that will be appropriate for some clients and won't be for others, but we're not advising them. And it's not someone who we have any control over as such that is advising them. It's an independent broker, and I'm interested in that one, because insurers as well, I mean, as it happens, I'm still a non-exec director of an insurance company, and I'm interested that insurers and brokers and MGAs, I'm interested in the extent of oversight that you expect on that, because it starts to become quite difficult, where the broker really is independent and chosen by the insured. But you know, anyway, the changes are that there's more of us, and some of us are bigger. There's also the broker MGA, which you know is an interesting concept as well. The soft market MGA that pops up at the end of the soft market to give brokers another way of earning more commission on ever lower premiums. It'd be interesting to see how long they last. But yeah. There you go, food for thought, something for the panel to discuss.
Thank you. We will definitely come back to some of that. So hands up all the soft market MGAs. later. So Mark, as we've been just, discussing what we were talking about earlier, claims delegation is often spoken of as a secondary activity from risk underwriting, but as claims, is key for the policyholders. The role of claims management companies seem vital to the market, and you've probably seen as much of that as anybody. So we'd be interested in your thoughts.
Thanks, and thanks for inviting me here today to represent the voice of claims. In my previous roles, I've I suppose I've been involved in managing some very large claims outsourcing contracts, as well as being involved in reviewing performance of claim service providers, outsourced claim service providers. And in reading Simon's FCA thematic review riveting report, I wasn't surprised at all to see that it highlighted a number of concerns over underwriters' oversight of outsourced service providers. I think from my perspective, when contracting with buyers of TPA claim services, or when reviewing other service providers' performance under their outsourced claims management contracts, I've experienced significant differences in approach or inconsistencies in approach, not only in terms of the due diligence of those claim service providers, but also in the way those contracts are managed. And I think, it was quite pleasing to see that the report was very heavily focused on the customer experience, and we've seen around the world now that this is becoming more and more, much more prevalent, the customer experience or conduct risk in dealing with claims. 5, 6, 7, 8 years ago, we spoke about it, but it was a philosophy as opposed to something that we tried to measure. And interestingly, one of the contracts I've been involved in, conduct risk, this particular entity was very sophisticated in measuring. In fact, went out to all of their customers, all of the people that had an experience in the claim, surveyed them in terms of a number of measures, and the outsourced claim service provider was remunerated, significantly remunerated on their performance with regards to the customer experience. And I think we're going to see much more of that as the focus moves in that direction. So what does that mean for claims and outsourced claim service providers? I think as underwriters, carriers are put under more pressure to manage their regulatory compliance and obviously their conduct risk and the customer experience, we're going to see that being transferred to TPAs. It is a much more complex environment now, and it's a lot more onerous for those TPAs to produce the management information that is required. And I see Lloyd's are ahead of the curve in asking on the front foot, and they've outlined their requirements in terms of data that's required to collect from their cover holders and TPAs, and that's going to be. That's imminent. That's now in January 2016. So I think the little guys. I think the little guys are going to struggle. To be honest, it's going to be quite onerous to deliver to these requirements, and TPAs are going to be required to demonstrate, that they've got claims handling philosophies and customer experiences embedded in the business. They're going to be able to. They're going to need to demonstrate that they can measure that and they can perform to that. They're going to need to ensure that their claims handlers are appropriately trained and qualified. And they're going to need to be able to demonstrate that complaints are properly recorded, escalated, that the conflicts of interest that Simon alluded to are dealt with. So, it's a changing world, and I think it's going to move quickly from here.
James, effectively there would be no delegation of authority as things stand legally without the principals like yourself. So why do you delegate? And what is it you're looking for from your sort of MGA and claims delegation partners?
It's a big question, Sian, and I'm not sure I'm going to get to all of it, but thank you for inviting me, and thank you for letting me go before Chris. You've obviously been away from the market far too long. We know where we stand in the food chain as carriers these days, and it's pretty low. But just as a bit of background, I have a very easy job in that I've got one shareholder, my capital provider, and he wants me to return a 15% return on his investment, risk adjusted and investment income adjusted, which is it shouldn't be a big ask, really, should it? So we built this nice little London wholesale business and Lloyd's syndicate with the idea that we would mine the London wholesale market deliver a consistent return on capital way in excess of that rather pathetic 15%. And very quickly we figured that a relatively small Bermudian company without any great infrastructure on the ground would struggle to do that. Fast forward 10 years and you probably wouldn't even bother starting. So, you know, the London wholesale market as it is currently constructed, I think, is best summed up as dysfunctional. Pay-to-play has been gone and returned. We are held hostage by some of the bigger broking houses, and increasingly the second-tier brokers that we turn to are merging amongst themselves to try and retain some value for themselves and their customers. So in an effort to fundamentally diversify our portfolio, we went looking around the MGA route. As Sian said, we had a legacy experience with Dual. We still have a relationship with Dual, albeit a much smaller one than we started, because they'd probably eat us. It's trying to wrestle an alligator. I think they're $1 billion MGA now, and we're still stuck at about 500 million in London. So, you know, quite a differential there. So we looked at it really as a portfolio diversification play. We wanted to get into the UK retail market. We didn't want to build infrastructure. We're not a flag planting company. And the MGA space is one that we had one direct experience in Europe, but we also had some history and positive history in the US. So the US experience of writing cover holder business was stickier, it was better margin, it was less price elastic, it would stay with a carrier longer than wholesale, large account business, call it what you will. And all of those fundamentals, I think, if we can align interests, remain true today. It's very hard. I mean, it's a very, very broad church from the Dual to the mum and pop shop. But, within that, our job is really to keep looking, keep digging for where we find, I would say, social and cultural alignment. And that for us is more important than anything. To be honest, the product comes much later in the engagement. We want to stare the MGA owners in the eye, and we want to know that they are the owners because, again, we want to sniff out and smoke out the people who have what I would say are different agendas, potential for conflicts of interest. So first in our hierarchy, we love owner-operators. They're passionate about what they do. They often have deep, elongated histories, and boy, can they bore you with some of their stuff. But we love them. And in fact, when you go around and you look at the demographics, some of those guys are getting older. Some of them want to retire. Some of them feel trapped. And that's where we can get involved. So we can either come in with a mix of underwriting capital, some regulatory oversight, or we can come in with some equity capital and, look as a potential retirement plan for them. At the other end of the spectrum, I'd say, least in our sites are PE or VC-owned and operated businesses. They tend to be in for the out. You're not sure quite who you're dealing with. So, it's a very broad spectrum. So we haven't even discussed the products and all the good stuff about customer outcomes yet. But at the moment, I'm really focused on the pre-underwriting cover holder due diligence and getting that right.
Thank you very much, James. Have we got any PE people in there? I didn't register whether we did, actually. But anyway, that was an interesting point there. So, Chris, last but not least, and obviously you sit between all of these parties by placing the underwriting facilities for either MGAs or broker cover holders into the market. So you're seeing things from everyone's perspective. But what would be probably quite interesting is what you're actually seeing developing in the market, and where you think the future of this space may be headed in certain directions.
Thank you. And thanks everybody for coming as well. It's great to have the opportunity to talk. As a broker sitting here, if anybody actually is like forming an angry mob, I've got my henchmen just down the back, and if you look, they'll wave back to you. So, and we've not come here to shamelessly sell our wares. Far from it. We just want to give a perspective of what we see and what we're trying to do in the market and how we think that's going to operate. For us as a business, 90% of our customers are independent MGAs. And that's something that gets lost a lot of the time in the market, where, as people have said, there are brokers, and Arthur J. Gallagher does also own coverholder businesses as well. But 90% of our customers are still that independent MGA, often run and operated by the owner and the principal shareholder. And I think that's an important place to be, because for us, our business is about trying to make sure that their contracts ultimately aren't just placed but are managed so that they can be sustainable for the future. If you look back at why MGAs really exist, and we get lost in this sometimes, it's very simple. It's either proximity, because historically and particularly in the Lloyd's market, these businesses were in far-flung places and they were providing business back into the market as what was referred to as a correspondent. Or, and more these days, it's very much the case, they're a specialist. So it's either based on location or specialty or both. I think the best MGAs that are out there always define themselves because of one of those two features, and sometimes both. And they do add value, because they add value to the policyholder fundamentally by creating choice that otherwise wouldn't be there. They deliver value to brokers, who now in turn have a choice, a further choice for their own policyholder. If they're good, they deliver profits to underwriters and their capital providers, and they deliver value to their own shareholder as well. So we all know that that's very idealistic, but it goes on day after day. I don't think we know many MGAs who deliberately set out in any way to cause a loss. They're all trying to make money, now more than ever, because these vehicles are perceived and as very valuable, and they create assets which are commonly, and we've all seen in the press, sold for very high multiples. That doesn't happen if you're a loss-making bad business. Due diligence will find out that what's underneath it actually isn't sustainable, and I think that's very important. Some of the key things that we see at the moment as a broker in the market, regulation is a very hot topic, and it's something that we take very seriously. We like to help our cover holders to interpret what they need to do to try and keep them ahead of the curve. We take our lead from the regulators and we listen to what they do, and we employ people in our team to help get that message to our cover holders. And Peter spoke earlier about having to get to the cover holder, having a relationship with them, helping them understand, because it's an important part of Lloyd's business. That's the same for us. We don't want people to be shocked and surprised. We want them to understand what's coming down the pipe, what they need to do for the future. At the moment, everybody's talking about conduct risk, and it's a very important issue. There are others. It's one of a series of issues, and it's certainly not the last one. It's an expensive business, making sure that regulation and compliance is where it should be. Just live with it. We've had to. We've invested in that, and other people have to as well. Another area that's a big hot topic is data. And I think there'll be some people in this room who may break the mould, and actually they report their risks within the month in which they're written. But unfortunately in this industry we lag so far behind other financial services in how we report things. And it's incumbent on all of us to try and change the way that that happens. Getting a spreadsheet at the end of the following month, if you're lucky, really isn't the answer to this. So that when you talk to James and you say, actually, there's a claim on this risk, he'd rather know he was on it first before he heard about the claim. And I think that's important. So we are trying our best as a broker to empower our cover holders with real-time risk reporting. It's difficult, don't get me wrong, and we're not perfect. But if we strive for that more and more, we'll be able to get there one day, I'm sure. And it's something that we work with our cover holders on, trying to get them in a position where they don't produce a bordereau anymore. Because it's an odd thing when you look back at it, particularly when you compare insurance to the banking world, that we actually have a spreadsheet that contains the details of policyholders and that's sent to, ultimately, a capacity provider in the end. Insurers themselves, I think, and we are in a perpetual soft market at the moment. I think anybody can ignore that. And as we move on through that market, everybody's been examined by the regulators, commercially by each other, around what people earn from this business. Brokers certainly have been looked at in great detail, and we've explained our earnings to people. we've had to diversify our service as a wholesale broker simply to keep relevant and to have a place in the market going forwards. If we didn't do that, if our job was simply to place capacity, I don't think we'd be around for much longer at all. There's lots of people here, I'm sure, place their own capacity all the time. And that's absolutely fine. Ours has to be a proposition that says we're more than that. And when we look at that, it's about the capacity that's out there. It's about new capacity, new ways of doing business. Some of our customers are very hot on the expense line of their insurer, what they get back from that. Is there somebody out there who can offer a better valued product to them? And there are new types of capacity coming into the market. Reinsurers, pension funds, hedge funds, people have seen them. And they've been writing particularly in the retrocession market for a long time. And they've seen what returns can come from this industry. And because they now view insurance as an asset class, they want to pursue it further, and they are getting closer and closer to primary business. Reinsurance itself is another topic. A lot of our customers often say to us, if they're a certain size and shape, that they themselves would like to control more of the reinsurance that sits with their programme. We always say the same thing to them. You've got to deliver something that's a better valued reinsurance product for your carrier than that which they have themselves. And that means it's going to be very specific and modelable and demonstrably produce better results for them in the end. We support that where it's possible, because what that helps is the philosophy that the contract's for the longer term. And that's good for everybody in the chain. That's good for the policyholder. If an MGA disappears, if their loss ratio completely blew up and there was no capacity, that's one less choice for somebody when they're placing their insurance, when they're buying their insurance. It can help to spread losses throughout the industry. It can lower deal cost ultimately as well. So that has to be a good thing. And then it leads itself on as well to the other thing that we hear the most from our customers is length of contract. Now, we know that if they're doing a deal in Lloyd's, they're going to be used to the way that works. It's predominantly a 12-month contract. You're going to spend a period of the year renewing it. More and more, there are insurance companies offering much longer-term deals, up to 5 years in the market. And some customers prefer to go that route. Ultimately, the real answer is that there shouldn't be a big renewal meeting once a year or once every 5 years. It should be a continuous process and pretty transparent about how things are performing. I think they're the key issues that we see from our side as it stands, and I'm happy to elaborate on any of them. Thank you.
So that's quite a wide range of options there in terms of subjects for discussion. But just by way of a sort of starter, obviously amongst yourselves, the Charles has slightly posed a question maybe to both Simon and Peter about the sort of the oversight of the sales side of things. And I had an example yesterday actually where it's only when you look from the outside you actually realise how confusing people find the number of parties involved in an insurance transaction, particularly if they're trying to set up the customer sales end. So I met a lady yesterday who, she's actually from an e-commerce background, so she's not from an insurance background at all, and she's actually trying to set up a pet servicing business that obviously is kind of tangentially linked to the insurance that goes with it. And it was just quite funny sitting with her for half an hour, and she's saying, so this guy, so you can absolutely see when you then do an overview report that it is actually very difficult for people to work out who does what. But anyway, perhaps you could address Charles's point on the oversight of the sales process or otherwise, but either one of you.
I'll pick up first, and if I'm not answering your question, come back and pick me up. So I think you're quite right about the difficulty in terms of writing an overall report from our perspective in this, because there is such a variety of different business models, different interactions and different relationships that are at play in the market here, that you cannot come up with one clear set of guidance, answers, responses to it. So I think from our perspective it is very much the first step is to be able to identify who is performing what function in that chain, and specifically who is the product designer, the product provider in that, and who is the distributor in that, because they're the two key elements around which a lot of this pivots. And then from our perspective, I think that provides greater clarity then in terms of the product, the product designer obviously has to have a view to who the customers are, the target of the product, to have some responsibility to make sure that actually that product is performing in the way that it's expected through the course of its life cycle. Would be providing information to the distributor, or if it's direct, providing information directly to the consumer. The distributor, again, has very different or slightly different responsibilities. So the distributor, as a regulator, we do focus on very much in terms of the financial promotions, the sales process, the activity that they're undertaking. But it has to have regard as well to that chain and the responsibilities within the chain, because if the product is manufactured, designed further up the chain and being distributed, there's also some responsibilities going back up through the chain.
Okay. I'm probably just being thick, but when I read the thematic review, I read in that there was an expectation that insurers, and therefore MGAs, because after all we are insurers' agents, should be overseeing the sales process and have responsibility for it. Where we deal, and a lot of us only deal with brokers who are independent and directly authorised with the FCA, we have very little control. But we're very glad that the insured is advised by an independent, properly authorised broker, because they should be qualified to give them the advice that they need as to whether our product is suitable. We think we've got some great products, but they're not suitable for everybody, and we accept that. Otherwise we'd have 100% market share. Lord, that would be a wonderful situation to be in other ways, but we recognise it can't be. And so, really, have I misread it then? And where there is a properly authorised independent broker, that you would expect them to be making sure that they're giving the right advice?
You would expect them to be giving the right advice, but the insurer also has a responsibility to ensure that the product's performing the way that it was designed and expected, that claims are being handled, the complaints are being handled effectively. So it's looking at it as the chain and the product life cycle, and making sure that actually through that there's appropriate responsibilities and accountability.
So I was reading more into it than I should have done.
Yes, but part of that is also making sure that there's a substantial, an adequate and appropriate flow of information through that chain as well, to be able to allow those
everything else you said in it. I think everything else you said, points very well made. They apply more or less to most MGAs, and hopefully there are some islands of perfection out there, and the rest will become mainstream in due course.
So not rolling back on what I've just said, but also just as nuance to that as well. If the broker is relying on the information that's supplied by the product provider, the insurer, the MGA, and passing that information on as well, then there is some responsibilities there. So there is some due diligence to make sure that actually any advice or product information that's supplied is either direct from the broker, and that's the broker's responsibility. If it's not, then there is some reliance back up the chain.
Good, that's a relief. Thank you.
Sean, can I ask a question?
Please. Let me give you a...
Sorry. Brian Russell, APC Underwriting. Where does the FCA actually see what an MGA is? Does it see it as on the insurer side, or does it see it as an intermediary in the middle between the end client, the buyer, and the insurer?
So from a classification point of view, we see it as an intermediary. We recognise the responsibilities and the roles that it has to the insurer. But again, it depends on the function and the activities that it's actually undertaking as to which elements of this regulatory lens that would apply to it. So if it becomes the product designer, product manufacturer, or it's involved in the claims and the claims handling, we look at it slightly differently than if it's just a portal for the product and the insured manufactured product through to an intermediary, a broker, or whoever it might be further down the chain.
Okay. One of I think the problems, which I endorse what Charles Manchester says, is, Peter, you mentioned the UAs in a term of cover holders, and of course MGAs have a fiduciary duty to the insurer. So there's a confusion there which needs to be resolved, in my opinion.
They do, and the fiduciary duty recognise. but also where they have customer responsibilities. So if it's manufacturing the product, designing the product, handling the claims, or marketing directly to the customer, there are customer obligations there from our perspective.
Yeah, a lot of work to do there, I think. Yeah, okay, thank you.
So you've heard a lot from the panel. Who would like to ask what? Have we got some questions coming from the floor? Go on, Marco. I'm going to pick on you then, as you volunteered. That if there was it's always that terrible thing when somebody says, "Has anybody got a question?" Isn't it? And you're all bursting with questions. I know you are.
Hi, Marco Del Carlo from Tempo Underwriting. One of the things that hasn't been touched on today is Solvency II and the impact that's having through the market. How do you see that flowing through in terms of carriers, and therefore how's that going to flow through in terms of delegated authority going forward?
So Peter, maybe you'd take that one initially, would you?
Why not? Thanks. Well, we've already done a lot of work in terms of making our binding authority wordings Solvency II compliant. I suppose for the Lloyd's market, the big challenge going into next year is the reporting requirements on Pillar 3. Without wanting to speak too much out of turn, with the reporting requirements on where we are on conduct, it's very difficult to challenge anything that we're being asked to do there. It all makes perfect sense in terms of understanding the business and making sure that the customer stays at the heart of our business, or their interests stay at the heart of our business. Some of the reports we're being asked to produce for Pillar 3 next year are, first of all, they're going to be a challenge in terms of counting the number of claims between certain values, and counting the number of claims that are cleared at a zero and not actually settled, and then adding them all together for leads and subscription markets together. So it's going to create a lot of work for the market. At the moment, I do struggle to see, and I have tried to look at it from the other side, what actual value this will produce. So I suppose the impact of Solvency II for the DA market, certainly for the Lloyd's DA market, is going to be a lot of work. There's already been a lot of work which is relevant, and we've made amendments. But I have to say, on the reporting side, I wish I could find what the purpose of that's going to be. I'll probably get a kicking when I get back to the corporation now, but we think we can deliver those reports. We've worked out how we're going to do it, but I look at what we're actually going to present, and it really is going to be a challenge. The good news is that the way that we're going to do that, we don't believe we're going to have to go back to our cover holders to ask for any more data. We're going to be able to do that centrally, but that is going to be a large part of our time. So that's sort of just one small part of Solvency II.
James, I mean, as an insurer, you've probably spent the last 5 years of your life on Solvency II. How aware do you actually think the intermediary market is of just how exacting this is for you guys?
I don't think they're aware at all.
Mm-hmm. Is that true?
I would say of the intermediary market, including the big brokers who are not in the room necessarily, they don't have any concept of how onerous this is from the carrier side. From my perspective, very simply put, from 1/1/16, this is about regulatory capital and holding sufficient regulatory capital to on a risk-adjusted basis to match your exposures. So from a cover holder perspective, life doesn't necessarily change too much. But I agree with Peter, the real challenge is going to be the flow of MI and the reporting of MI in the way we have to report back to the regulators. And I think we've got a challenge around data integrity and efficacy, which has always been there. But now we have an additional challenge of timing that we'll have to get our heads around. But it is, at the end of the day, it's an expense. It's an insurer expense that in the current market I'm having to wear, much to the chagrin of my owners and shareholders. However, there's no other way to absorb it. So if you look at the infrastructure cost, the carrying cost of now running a business, a diversified business of wholesale and cover holder business, the cover holder business is really taking the time and energy, and that's where the jobs are, if you will. So, we've probably, in a fairly small time, added a staff of probably 20 full-time employees solely dedicated to binder management, cover holder management, et cetera, for not a dollar more premium income. So that all just sticks to the ribs in terms of expense. So, I'm not trying to dumb down the whole Solvency II process. I mean, I'm quite happy to quit on the spot when we fail to make it. But I do think the carrying cost is somewhat ignored, and certainly Pillar 3 looming is going to be the real challenge in the reporting sort of environment is going to be the challenge for carriers.
I think it's also another reason why insurers are going to be asking MGAs and cover holders for a lot more information going forward, because in their capital models they have to recognise where risk is, or the capital models are driven by risk, and business that they have little control of is going to be a much higher risk for them than business they have lots of control of, which is why they have to have more control of the business that the underwriting agencies write for them, which is only reasonable because they want to keep their capital requirement lower.
Yeah, it's a good point, and it's probably one of the driving reasons behind us wanting to almost get into the ownership of distribution rather than renting it.
So does anyone here...
Go there
there
if
we
you
go.
want to sell up today.
So does anyone here, as an MGA, does anyone here actually bear risk? Have any of you got... I could look in Brian's direction again. Have you got yours up and running yet? But,
Not quite. It's
no.
1st of September.
Yeah. Does anyone else? Yeah. So why do you do that, and how do you manage the conflicts involved in that? Sorry.
Yeah, hi, Nick Ferrier, Pioneer Underwriting. So we bear risk through an arrangement with Liberty Syndicates, through what is known as an incidental syndicate number. The reason we do it is because we see it as being a partnership with our carriers. So our carriers therefore have confidence in our underwriting. Our underwriting is focused on profitability, not top-line growth.
Any views on that, Chris? Should MGAs have their own capital?
Yeah, we'll come on to it. Absolutely. I mean, it's we encourage people if through a life cycle. At the end of the day, we know that most MGAs in the market at the moment, some stay for the long term. By the way, some sell, some convert, and it's not uncommon to look at MGAs moving on to a risk-bearing basis, either inside or outside of Lloyd's. It's not new, by the way. I'm interested in that arrangement particularly, and we've seen what's gone in the market with Pioneer and Liberty. I'm not sure, and I'd have to have it explained to me better as to where the capital actually comes from, as to whether or not it's more or less than a true risk-bearing arrangement. But look, I mean, there are a lot of people out there who want to go down that route, and we're here to help them do it. We've done that on lots of occasions. By the same token, by the way, we just talked about Solvency II, and there's a huge bunch of people coming the other way because they simply can't access enough capital to sustain what have historically been absolutely fine insurance companies with adequate reserves, who are now going to have to change their model, move to maybe more co-insurance based models, or move a bit further down into a straight MGA model. So this room could grow. It's very common throughout Europe to see that. There are lots of small insurance companies in this country. It's very common in Europe as well. And anywhere where equivalency exists, we'd expect to see more and more of that happening.
James, do you worry about the MGAs disintermediating you, finding a way to go direct to capital and not needing your...
Well, they'll find a way, yeah. So I don't worry about it.
Mm-hmm.
No, it's, there's so much that's thrown up in the air at the moment with regards to capital, that capital is the least of anyone's worries. It's so fungible. So yes, people will find different vehicles. You see, different structures morphing all the time. You see panels of reinsurers almost looking for a primary carrier to be the paper, and it's just an arbitrage. Is that right? Who knows? But it happens. So I don't worry about that. What I think we still try and get to is, as I was speaking earlier about, is this cultural sort of assimilation. And I think when if it feels right and it looks right and you've done all the DD and you like the people you're dealing with and you've had a long-term relationship and it still feels good, then those are the people we will remain true to. There's a lot of stuff that's hokey and, the same old stuff that's rebadged. I haven't seen a new product in 30 years. It's all it's all kind of old. Inga Beale talking about the Uberization of it. If Google comes into this space, we're all toast. So it's not there yet. But people coming in with different capital structures, I don't care about that really.
Well, there's a challenging statement. Does anybody have any views on that? Okay, Mike, can I pick on you just because you happen to be sitting in the front row? But you've obviously set up your own MGA fairly recently, but obviously you've had quite a long experience of the thing. So, how have you actually found getting a new MGA in place and having to get your capital from the market? And what's been good about that and not so good about that?
Thank you. It's been an excellent experience, and I think that there's a lot of diligence being done, and I'm glad to say that we've had to go through a number of, every time we get extra capacity, there's lots of audits done, there's lots of checking on the compliance and the processes and systems, etc., which is very reassuring. But I do worry that there's still this the broker in the lamb issue where capacity can be handed out without that, and that's something that decimates our business. And I'd just be interested to see from James and some of the other people on the panel how they think we can, as an industry, stop that happening, because you see it time and time again where there will be a format set up where people understand the risk and are charging the right rates and doing it in the right way, and then all of a sudden the whole market gets affected by somebody foolishly being handed the pen that the carrier thinks is doing well for the first 12 months, and when the claims start to hit them, they realise they haven't, and it's decimated that market in the short term. So it's just interesting to understand, having gone through the process of starting a business and had to go through all the loops and dot the I's and cross the T's, how these things can still happen and are still happening in this marketplace.
Say something.
Well, people would probably say that I usually do my best to stop new people coming in with our rules. We're fairly diligent in who we allow in, and we want to see value added to Lloyd's. Up to a point, there's a competition issue that we have to keep mindful of, but as much as we can control it, then that's the situation. But it's the market at the end of the day, and if you're a MGA working for one or even two syndicates, there's another 88 syndicates out there probably interested in similar business, and there's that's the problem you've got and the difficulty we've got. All we can make sure is that anybody that comes into Lloyd's is of a capability in terms of their underwriting and their compliance.
I think you'll probably find insurance companies saying exactly the same about other insurance companies as well. And thank God for it in a way, because without it we wouldn't have hard and soft markets. And if all we had was one stable market for eternity, there wouldn't be any room for people to be entrepreneurial and to do things better. When it happens to you, you wish that it hadn't, but there will always be foolish insurers out there that give the pen to people they shouldn't, and they might tick all the other boxes. Sometimes they can be extremely highly capitalised, and the customer will get a perfectly good experience. The insurer will simply lose money on the deal, and it can be very inconvenient when it happens, but it's always happened, and it'll never change, I think that.
I think I'd add to that as well. And it'd be interesting actually to get a view from the regulators here as well, because you're absolutely right, that happens a lot. And we tell our customers when it happens, sometimes you've just got to ride it out, because if they are doing it badly and you're right, they'll get found out. Short to medium term pain for you though, because there's another guy down the road knocking it out at half the price. Does he really know what he's doing, etc.? The analytics that sit behind something like that are important. But even if you can prove to your backers that you're definitely doing it right and it's going to make the right returns for people, it's very difficult to turn around and point the finger at somebody else. And we've spoken today, and the reason I mentioned the regulators in the room is we've spoken today about product and how things operate and do they function properly. Portfolio is equally as important, because if you're right and a guy comes on the street who starts, stacking it really high, that's not good for the consumer at the end of the day, because it's somebody who's there now and he's only going to disappoint when he's not there next year. So my insurance I bought from that guy last year, and it only cost me this year I've got to pay nearly twice the price. So there's an element of that, and I'd be interested to know from a regulatory perspective about portfolio as opposed to individual products. And I don't know if there's a view on that from either Peter or either of you actually as to how we view people coming in and out of the market like that.
Well, I think all we can do is challenge our underwriters. So, as you know, all our businesses go through a business plan process. We have to challenge them on their underwriting capabilities and their expectations, and make sure that what they're telling us makes sense and has value. It carries some sort of weight. What we can't do is get down to and I do get phone calls from underwriters telling me that, and there's another underwriter who's undercutting them by 50%, and I have to turn around and say, I'm sorry, I can't take this call, I can't deal with that, because we're not allowed to go down that road. We deal with things at a syndicate level, trying to make sure that the people that are writing on behalf of the syndicate are sufficiently competent that they will spot those things for themselves. But certainly what we can't do is go down beyond that to start telling people what business they can write and at what price, even if sometimes we may have our suspicions on who the good guys and who the bad guys are.
So I think for us, there's a couple of regulators obviously play in this space.
Yep.
So there's a PRA and FCA. PRA obviously do have a view, particularly in terms of the underwriters, around the quality of capital and the quantum, as well as the quality of capital, to be able to underpin liabilities. There's also, we sort of alluded to and sort of talked around innovative capital and new capital flows coming into the market, and that undoubtedly does have an impact. We, as the FCA and the PRA, have both been looking quite closely at that and looking at the source of the capital. From a PRA perspective, more around thinking around that cyclicality point and hot money coming in and coming out, and what the impact that could be structurally across the market. But I'd also point to actually that we have seen crystallised risk issues, which might hark back to Solvency II to a little bit, from capital coming in from other jurisdictions that actually has not been there when it's been needed.
Yep.
And we've done quite a lot of regulatory work together with the PRA on that with our EEA colleagues. Solvency II hopefully will be a real benefit from that regard in actually levelling up the playing field in terms of making sure that there is consistency of focus on that quality and quantum of capital across the markets.
On that subject, do you believe Solvency II will be interpreted and regulated in the same way in Latvia and Estonia and Bulgaria and Romania as it is in London?
I wonder why you pick on Latvia or Estonia. The European regulatory...
Can I just say, as I sat in on board as a non-exec chairman of a company that you're quite right, Solvency II has possessed us for the last several years. And listening, I have often thought, I wonder if they're having the same kinds of board meetings in Latvia.
So they're pressing the room, so I need to be very careful about what I say and what I articulate. And I'm not the PRA, so I can't answer for the PRA. Solvency II would be a failure if it isn't uniformly implemented, not to the last nth degree dot and comma, but uniformly implemented across Europe. There's a regulatory structure in place to ensure that there is actually challenge and testing on that, and it's incumbent on the host or home regulators to challenge where that's not the case. So in instances where we actually have seen so far, real issues around failure from a consumer point of view because the quality of capital from other jurisdictions hasn't been there, we have vigorously challenged that and gone back to the home country regulators.
And what did you think of their responses and the people at the other end?
So we have a good regulatory dialogue with our colleagues and counterparties across the market. Some are more intensive and fruitful than others. But as that's pre-Solvency II coming across and Solvency II being more of a lever to make sure that actually there is that consistency. The flip side, just on the Solvency II piece, just thinking about it more domestically and prosaically, is one of the areas is that we fully understand as a regulator there's a regulatory burden on the whole industry, from us, from Europe, from Solvency II, from Lloyd's. We're not looking to add regulatory burden across that, but one of our concerns is also that actually, thinking back to what Chris was saying earlier, conduct isn't just a risk, actually it's a portfolio of risks, and there needs to be a balance and a focus on that portfolio of risks. But that needs to be a balanced view as well, and there's been a heavy debate on Solvency II and prudential risks here, and I'm not looking to swing it back to conduct, but equally we would want to make sure that there is a balanced focus of prudential and conduct issues at the boardroom, and also through some of the management information flows that we've been talking about.
So, ladies and gentlemen, we're near the end of our time, but I'm just rather conscious that Mr. Mark has had a rather easy ride here in terms of. So, I was just wondering, some of you must hold claims delegated authority, and I just wondered what you do with that, whether you actually do delegate it to a third-party company. And unfortunately, I can see in my eyesight Mr. Downey, who obviously worked with me at OIM, and I know that claims has been something that he's had quite a focus on. So I wondered if you might share a few of your thoughts about MGA's handling claims.
You asked me to ask a question or asked me to give some thoughts. So I guess it comes to the point really from, I worked at RSA for 25 years. I've recently joined Penn Underwriting for 7 months, and my view it's down to the customer, and the customer must get a brilliant experience. So that's that really. Their claim must be handled fairly, it must be handled logically. If they need to make a complaint, that needs to be understood, and we need to understand the root causes of those complaints. So as an MGA, we get that constant feedback loop that says, this is what's happening, these are the issues, these are the concerns, and equally to understand from an analytics and pricing perspective where we may have defects in our product, where we may be, our product needs enhanced, wherever it may be, and equally where we handle some special kind of products, understanding the performance of those products. So I think the issue really, it depends upon the competency of the people, it depends upon the competence of the firm, but ultimately it's about the customers. And if we're seeing complaints rising, then we need to understand that and why. And equally, I know it's a common debate going on in the industry right now, what happens in surge events and who handles claims in surge events. So when we get something like 2013, early 2014, how can the customers make sure that they're not affected and they're not put to the back of the queue? So it's about finding that, and equally it's about the efficiency of the organisations, because I don't know who said it at the very start, but the customer pays and then everybody's taking something out of that chain. And it's about who the most efficient is at delivering that and delivering that customer service to that customer and across that business. And if there's inefficiencies, then they will be found out in a perfect market. And we're living in a pretty perfect market right now. And we have to accept that. So that would be my perspective.
Okay, I'll be less subtle than Tom then. So basically, during my tenure at OIM, we had a large delegated authority on the claims side, which we actually, we employed a TPA to actually manage those claims for us, which I have to say was an exacting and interesting experience. And in fact, I think it's now the case that the decision's been made, in fact, to put the claims back to the insurer, who's actually the main insurer on the facility. Forgive me, Tom, if that's not entirely accurate, but that's the gist of the question. So I wondered, you must see this flux between the principal handling the claim and delegation out to yourselves handling the claim, and you know, how do you see that dynamic working, and what do you do to try and maximise your involvement in the chain?
Well, I was,
last question, I promise, because I know it's very hot in here. So
I was personally involved. In fact, I was sent back to Australia packing because I was, in my previous role, was head of exchanging claim services, and I was one of the unfortunate sort of casualties, I suppose, of the market shifting from we want centralisation, we want visibility, we want to be able to do it, we want to build capability. We achieved all of that. Okay, thanks very much, we got all of that. Now we want to go back and we want to handle those large and complex claims ourselves. It's our shop front window. This is our brand. We want to be able to differentiate ourselves, and it varies between the two. So quite honestly, in a market like we're in now in the UK, for example, lower transactional volume type claims, we're seeing that going back to an in-source arrangement. But rest assured, when the next surge event comes along, they will no doubt be asking us what our capability and capacity is to service that, where you're able to deploy resources globally when obviously a type of hedge, if you like, when you can bring resources in from around the world to cope with it, whether they're large or complex or whether they are smaller transactional volume types. So yes, at the moment for us it might be a perfect world for underwriting, I think was one of them, but it's certainly not a perfect world if you're earning your crust from managing claims at the moment.
All right. Well, thank you very much for attending, and thank you very much for our panel for giving us such a good overview of the subject. Thank you very much.